2, and hopefully I don't get another 3-second internet drop. If I do get another 3-second internet drop, I will not be coming back on YouTube probably until June. Yes, yeah. I'm sure that's going to be the way it works, Bill. I'm sure it's going to be me selling my house so you guys can hear me and not me quitting my job so that I stay in the house. I'm sure that's going to be the way. I am an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. And there's the position disclosure again, even though we just did this. Pray to whoever you want to that the internet does not do one of those drops on me again. What do you mean you still can't see the screen? In where? The virtual trading floor or the YouTube? Oh, interesting. You guys can't see it? It says on my end that it's sharing. Interesting. Let's try this again. Now can you guys see it? Yeah, there's 2 Derricks. That's exactly correct. It's me and the clone of me. All right. Anyway, the market was up. The dollar was down. Commodities were up huge. That's what we were just talking about, particularly this SLV. I was just mentioning that you had the opportunity to buy SLV at like 58, 59 after hours on Thursday night, which is pretty incredible. Crypto was red for most of the day, but did manage to eke its way back to positive territory. Honestly, that's a pretty poor performance from crypto. Weaker than the Qs, obviously weaker than the commodities, weaker than almost everything in this mean reversion bounce back trade that we've been looking for. Ethereum's up 3%, so I guess a little bit better from Ethereum than from Bitcoin. It sounds like Tom Lee over at BMNR was adding to his Ethereum position, which he better be. Don't frown, average down. All right, so look. There was a massive opportunity on Thursday into Friday, and it was really difficult to be able to capture that because you had to have the tenacity, for lack of a better term, to be buying not just into Thursday's close, but Thursday really after hours. You know, and I know we don't do an afternoon meeting on Fridays. We did one on Thursday, obviously, but you could take a quick look. Here, if I bring up the after hours chart from Thursday, I don't know what time we finished our afternoon meeting on Thursday. You know, probably around 5 o'clock, like we typically do. So it's at like 1700 or so. So we were already trading down a good bit with Amazon, but the market just continued to get smoked. The SPY is traded all the way down to 671 in the after hours. The Qs traded all the way down to 587 and change. And silver, what I was just referencing, traded down to like 7:15 p.m. Eastern time low of 58.50 basically. So all the way down. If my chart, my calendar, my candles, I mean, went all the way down that day, you would see this candle extend all the way down and basically close down at lows at 58.50. It's so hard to come in when the market's selling down. The market just broke support. I guess the SPYs were at this more major support at the close, but they were breaking it after hours. The Qs are below all major support levels. It's so hard to come in late Thursday into the close, or even worse, after hours, buy up stock and then swing it into Friday, because all of the typical principles that I try to espouse upon on keeping positions overnight were impossible. Having a good profit cushion, impossible. You're basically just buying into the close and hoping that you get the gap up the next day. I actually thought we were going to have that exact situation happen. Why? Because the Qs at that point were on a massive day 3 down as far as extension goes. And honestly, it was crypto. I was looking at crypto Thursday after hours, which also sold down, but then went through this huge rally here from like 7:50 p.m. till 8 p.m. to get all the way back up. And honestly, when I saw this like after hours V bottom with this pretty big volume for after hours trading session for that late at night for IBIT, look what it typically does at that time of the day. It barely has trades go off. I was like, that probably was capitulation in conjunction with just how extended things were at that point. IBIT just destroyed, and again, down even significantly more after hours. The Qs, just that extreme downside extension. And again, I know that this trade was really hard, and I was chatting with some traders here in the virtual trading floor about it on Friday, but you kind of had to put yourself in a situation, and this might not be right for everybody. This is probably definitely not right for anybody that's a smaller account, but you had to put yourself in a situation where you were going to be buying that down price on Thursday with the expectation that if we were actually to gap down again on Friday, which was a possibility, that you were just going to be adding more. Because at that point, the extension would just be so extreme that you need to capture, you need to come in and actually buy that. And, that's what we were looking for. It was really starting on Thursday that we were really looking for the mean reversion trade to begin. In other words, the reverse of the dispersion, the reversal, retracement probably is the better term, the retracement of the rotation dispersion trade that had just mutilated software to the downside and crypto to the downside and other areas of tech to the downside while ripping up other aspects of the market, most notably XLP. So again, it was really on Thursday that we started to look for that other trade. I was definitely a bit early for it. So on Thursday, I got a bit hurt. But, it goes back to kind of what I was just saying, like buying night close, buying after hours, and then the reversion actually occurred in a very difficult manner for traders. Being straight up honest about that. Sometimes the market makes things really, really easy. I think on Friday when we were talking about this, I referenced it just always is the first one that comes to my mind. I'm not going to bother to look it up in the chart, but the day that Russia first invaded Ukraine was like the biggest layup. It was the easiest day to make a boatload of money because we were already like 6 down days in a row, massively extended, and then because Russia invaded Ukraine, we had a massive gap down, but everyone knew that Russia was going to invade Ukraine by that point. Russia told the whole world, hey, everybody, starting tomorrow morning, we are going to invade Ukraine. And then we woke up, and guess what? They did exactly what they said they were going to do with the market gap down huge. And I was like, guys, this is like a day 7 massive gap down with extreme extension on news that's already fully priced into the market. And it was such a layup that day to be able to come in and just buy. Thursday into Friday was not that. It was not that. If we could have gapped down on Friday, it absolutely would have been, in my opinion. But Thursday into Friday was not that. We had an after-hours capitulation at like 7 p.m. and then had a big gap up on Friday when things were looking brutal Thursday night on the Amazon report. And you can see the SPYs have traded all the way back up. They recaptured 685. They're back to being within their range, but overall looking really, really, really bullish. The Qs have bounced back to their equilibrium area, but they're not out of the woods yet. The Qs actually still look bearish to me. If they can really start to get above like 618, 620, I would say that they're neutral. Right now, the Qs are actually still bearish. SPYs are neutral bullish, on the verge of being full-on bullish. Qs are full-on bearish, on the verge of being neutral bearish. And the RSP and the IWM and the Dow are just full-on bullish across the board. So we have a mixed message for the market, but what we were looking for on Thursday was just, all right, if the SPYs are moving sideways, I was explaining this to Greta today, this is just how this concept of dispersion works. If the SPYs are moving sideways like this, but one sector of the market's in a massive bear market, software, then something else inherently has to be ripping through the roof in order for the SPYs to be able to be sideways. And that has just been this dispersion trade. And this dispersion trade at this point is not new. I feel like because of options activity primarily, the increase in options activity, it's really brought about the increase in this rotation dispersion trade. But I remember at this point, starting a couple of years ago, for the first time, really starting to see days where the Qs and the IWM, even on 5-minute bars, would trade inversely of each other. And I had never seen that before. The indexes usually trade together to some degree traditionally, but one area has relative strength and one area has relative weakness. This was just becoming flat out things trading inverse of each other. And I was reading some stuff, over the weekend, and I'm not a statistics expert by any means, but it sounds like when you combine like the move that we saw in the metals, the silver moves that we saw in the metals, which were just completely insane, with what you're seeing in consumer staples to the upside, which they're now running in a way to the upside that's almost never happened before in the history of that sector. It's usually a very slow, boring sector. With what software is happening to the downside, like the statistical probability of seeing these moves is very low on how extreme they're getting versus history, and especially seeing like this many very, very low probability events all occurring within short periods of time with one another is like one of the most interesting factors out of all of this. And it's just created an extremely unusual environment where we're looking at the depths of this terrible bear market in software, having conversations that are bear market conversations about, well, what are the great companies that we can buy on discounts, versus seeing other areas, consumer staples, and Apple almost trading as a consumer staple, just completely ripping through the roof. We are getting multiple like one every 10-year events per month. It is how this year has started so far, at least. So we'll see if that continues. But the bottom line is Thursday into Friday, we're looking for this mean reversion trade. And it happened. It worked. And then today was really just continuation of that. So we came into the morning meeting today, and I was just looking at where the market had gotten back to. SPY's back in their range. Qs, working back towards this equilibrium area. I think when we were doing the morning meeting, they were almost back to the 80 MA on the daily chart, and seeing that, some of the meat on some of these software companies had already happened by the time I was doing the morning meeting this morning, and just like saying, I really don't have anything for today. And I know that, again, the market's giving me a mixed message. So one thing I would say, when the market gives you a mixed message, it just means a less is more approach is the better approach for the market. Preserving capital is a great thing. Cash is a position. Save bullets for when things line up. But we've got a little bit mixed messages from the market, though I would say more technically bullish than bearish. But the market dynamics to me and the positioning risk is more bearish than bullish. So again, I'm waking up today and I'm like, all right, this is good for me. Like, I made decent money today trading, but really all the money I made was just from a continuation of the work that I had done on Thursday. And as far as doing anything new, I didn't do a whole lot new. I tried to take a couple day trades here or there with some very, very moderate success, and the best being into the close when we saw the bearish action, the bearish option action happen from the institutions in the SPYs, the zero DTE stuff that we just kind of followed on. And those SPY puts that I bought them for 18 cents, and they traded as high as like, I don't remember, $1.20 or something like that in 30 minutes from when I bought them. And that was just recognizing that it was like this day two but upside grind, which those days a lot of times roll down in the afternoon, the last hour to begin with. And a smart money player was just whacking some puts at the same time that were zero DTE. I was like, okay, I'll just join this a little bit. And that was, a decent little day trade. But as far as the big picture goes, I'm very much in wait and see mode here, especially as the trades from Thursday are now unwinding, right? I am out of IGV. I am out of Oracle. I am out of Shopify. It's not Shopify. There it is. I'm out of Shopify. I'm almost out of Snow. I've got very little Snow left. I'm out of... no, that's the wrong symbol. What the hell was that symbol? Come on, type. CEG. I'm out of CEG. The only one that I lost money on that I'm out of is Spotify. I just bailed on it because of the weakness today. I still have a little CRM, but my position in that is very light. Microsoft, I was able to take a lot of that off today as well. And then the consumer staple short has actually been the harder part of the reversion trade, but that worked a little bit today as well. So I was able to reduce some XLP as it moved in my favor. I am out of a lot of Walmart short at this point as that moved kind of in my favor today. Got out of the vast majority of my Coke short. So that was it. And as those trades unwind and go flat, I don't like anything right now. The market's looking increasingly bullish, especially if you can take the NASDAQ out of the picture. But the market dynamics, the risk, I think, is to the downside, especially as we get to the end of this week and next week. So really, I'm kind of just in wait and see mode because I think that the market's giving me a mixed message, and I want to be more aggressive when the stars align and the market's message is the same across the board. One of the big things that I'm looking for two things. One is the SPYs to break Thursday's low, which is looking less likely. It's looking more likely that we're going to break out to all-time highs. But I'm looking for the SPYs if they can potentially break last Thursday's low. And I'm just looking for correlations to increase. I think that the big signal is going to be, and we saw like a touch of this on Thursday of last week, but it wasn't enough, is going to be when you see them sell everything at the same time. When they're selling the NASDAQ down, and Apple down, and NVIDIA down, and Amazon down, and consumer staples down, and crypto down, all on the same day at the same time as levels are breaking on the indexes. That's like the big thing that I'm looking for is correlations to increase, pound the downside. We start to trigger more systematic selling, pound the downside. And it just still seems like this week is just going to be more of a choppy week unless we get a catalyst, because we do have a lot of economic data this week that could act as a catalyst that starts to sell us off. But yeah, I mean, that's it. So that's all I got. Happy to turn it over to you guys. From Greg, I hope that is not the buy for Feb. I assume you mean Thursday's low. I was on the CPU short, covered a lot. I had a game plan to get long. Had Hood. Oh, Hood was another one that I was in that I'm out of. NVIDIA, which I still have some. But because it never stopped selling until 7:15, I bought small Hood, but not enough. It was really tough to buy, especially with small account and not wanting to carry any major loans overnight. For sure. I mean, first to admit it. That was an extremely difficult setup. It was what we're looking for, and the trade worked, but the execution of the setup, they made that just extraordinarily difficult this time around. One of the harder times I honestly remember it. So if you weren't able to capture it, it's unfortunate. It just kind of is what it is. But the beautiful thing about markets is that the market's an opportunity creating mechanism. So that time around it was really difficult. Next time around maybe it'll be difficult, but maybe it won't be. So we'll just try to be there when it happens, and we won't force it until it's there. From Tate, feels like they washed out the CTAs and other systematics just so they get full to that 99% again into the end of the month, just so when everybody feels safe. Yeah, and Tate posting the CTA chart that we look at in the mornings here as well, and you can see that very, very fast unwind from like Thursday, Friday last week in the chart, but it's still elevated enough that it doesn't happen that often, but look at most of the other bigger pull downs in this, and you're still going to see that sell down probably a little bit, because I think CTAs are sellers in Tate this week, but I still think that there is some risk to the downside. It's interesting, I think Greg was saying this, or Jim was saying this, how all over Twitter now you're just seeing the Goldman Sachs CTA information, and it's not that this information is new, it seems like more and more people are looking at it, to the point where I can't help but wonder, as I keep seeing these close saves happen, I can't help but wonder, if they're almost trading those levels now in a way that they hadn't previously, as everyone knows about it. You know, I'm like in the back of my head, I almost wonder to some degree if the edge of that information is starting to be impacted, but I don't see how, because forced selling is forced selling. It's going to happen systematically or not. It's not like the models are being changed because, like, to stay one step ahead of the people who are now gaming the models are changing. That's not what's happening. The models are staying the models. They don't care. So I don't know. I'm just yapping out loud now, but it's stuff that's been kind of going through my brain as I keep seeing these saves from bigger sell-offs. ON is out. ON is out, trading down. From Bill, just to say, correlations normally hit a low before and into earnings. So as we get through earnings, probably see them go up. Yep. Thanks, Bill. Great commentary from Eli. How do you learn to gauge risk on a newer name that you have never traded? Sure. It's a great question, and it's not one that I have a perfect answer for. I try to, if it's a newer name that I've never traded, I try to just get an understanding of like the general profile of the stock. Because while maybe I've never really traded that name before, I've probably traded some that are similar to it. So I'm looking at the price, I'm looking at the spread, I'm wondering if is it a new issuance, is it not a new issuance. I'm looking what the movements look like in the chart over the course of the last handful of days to see just like if it's a $20 stock. All right, well, some $20 stocks move $2 a day, and some $20 stocks move 10 cents a day. So I'm kind of just gauging, looking at the level 2, what the spread and liquidity looks like. I'm gauging the chart, what the typical movement looks like, and then I'm trying in my brain to create a game plan that appears to me to be similar to other stocks that trade similar to that I've been involved with in the past. And it's definitely more art than science on that one. And I talked about this at the end of last year. Like the biggest mistake that I made on my trading last year, which was a 7-figure difference on my trading account and profitability last year, was that mistake. It was exactly that mistake. It was getting involved in basically 3 stocks at the same time. It was kind of a multi-mistake, getting involved in 3 stocks at the same time that all did very similar things. So they all traded together, and I just didn't really know the names. I didn't understand how they traded, and the game plans I put on were just way too aggressive for how those things were trading. They just weren't a great profile for me from a trading perspective. So definitely more art than science. If you're not familiar with the name, just start smaller in it than you would otherwise. You're always better off making a mistake where you lose less if you're wrong and make less if you're right than making the opposite mistake. Because maybe you get lucky and you make a lot more than you should have made because you made that mistake, but that's not worth the opposite occurring, where you lose significantly more than you would have otherwise because of that mistake. So err on the side of being more cautious, I would say. From Tate, it was telegraphed how net short they were at the April low, so I think it's been out there. That's on CTAs. From Greg, meant on the CPU computer and watching and short and covering some, so it's not like I was jogging. For what it's worth, probably do the same thing if happened again, just not part of my current strategy. Okay. Over into the virtual trading floor. From T Brown, how is that not trying to catch a falling knife? How do you figure out proper risk? So that question is referring to the buying that you had to do Thursday into the close and potentially after the close. So the question again is, if you were buying into the close and if you were buying after the close, even if you were buying post 7:15 on the way up, how is that not catching a falling knife? How do you figure out your proper risk? The answer to the question is, it is 100% catching a falling knife, and there is no way to be able to properly figure out your risk. That's the answer to the question, and that's why the trade was so difficult. So I'm not going to make it to Traders for a Cause this year, unfortunately. But I was planning some months back because I thought I was probably going to go and probably going to speak at it. Uh, I was planning some months back actually to have my lecture uh, this year be on some common sayings in trading. Some that I completely don't follow at all, some that I follow sometimes, some that I think are terrible advice, and some that I think are the most important advice in the world, and kind of going through that. And catching the concept of catching a falling knife, and I'm going to add that. I've been trying to keep a little list here of trader sayings. Where is my list? I thought I had it on my phone. I want to add that to it before we forget it since we're talking about it. Oh, here it is. Catching a falling knife. Look, there's a way to catch a falling knife, is what I'm going to say. The first thing that I would say about catching a falling knife is the best thing to do is really not catch the falling knife and wait for it to stop falling. That's the main thing that we're typically trying to do. That's the main thing that I espouse for trading. With any of this stuff that's gotten really extreme from a mean reversion perspective that we've been looking for, what people in the morning meetings here on the virtual trading floor keep hearing me talk about is, guys, if you can catch the long or the short, if it was silver or staples, or the long if it's some of the software stuff, the risk reward is phenomenal. And there are opportunities to be able to get in for extremely little risk to be able to make that trade. So, but you want to try to buy it on the way up. I remember with IGV specifically on this day here on February 4th, which ended up not being the bottom, by the way, but you couldn't have known that at the time. It gave this phenomenal opportunity to be able to buy stock. It was like a 5-minute extreme extension, 10 a.m., 5-minute RDR trade with extreme extension on the daily chart as well, where you came in, you could have bought for 10 cents worth of risk, but you're buying on the way up, so you're not even catching a falling knife. You're buying on the way up, and then within 40 minutes, you're $3 in the money on your 10 cents worth of risk, and the trade failed the next day, but had reward potential at that time of conservatively like $8 on 10 cents worth of risk. That's just phenomenal risk reward opportunity. So that's what we want to look for, but because it doesn't always work perfectly, sometimes you just have to understand, and this is a good bit of what I do, but again, it just requires a little bit of a higher risk tolerance, which not necessarily everybody can do. A lot of what I do is at certain degrees of extension, I just kind of start building into the position where I am catching the knife in a very conservative way. So maybe I've got really big gloves on or something like that in order to help me capture the knife. So it's going to be, I have a lot of cushion. I think it's a fair analogy. I have a lot of cushion for how sharp is this knife. And, as long as the cushion is enough so that it doesn't pierce the glove, I'm okay. In other words, I can nibble, to use what Bill Cage just said. I can build in small. I can buy a little bit and a little bit more on the way down because I just have a game plan. Can you guys hear me? Can you guys hear me now? This is so brutal. Lost the YouTube. I'm not going back on the YouTube. Yeah. Oh, so what I was saying was, 10 years ago, if a new trader said this to me on the desk, I would have been so angry. I would have thrown him off the desk for sure. But yet now, full circle comes back around. You can have me saying it, where my out, if you will, how I measure my risk, if you will, which, I can't exactly know the dollar amount of my risk, but my out is the 80 MA on the daily chart, let's just say. And the reason why I would have thrown a new trader off the desk 10 years ago for saying that is because you're buying like $80, let's say, in IGV, and you're telling me that your out on the trade is the 80 MA, which is 86. I'd be like, what do you like? Who do you think you are? you think you could just the idea of an out is that's where you take your loss, buddy. You can't just buy at $80 and have your out be $6 in the money. If I could do that, I'd be a bazillionaire. But the thought process for me has changed, where my out in those circumstances is actually currently in the money, but it's moving down. And I recognize that how the stock trades will actually from that point where I'm buying that extreme extension will dictate how profitable I am, if I'm profitable at all, and the degree of that profitability. So I can start to layer in and layer out of some of these positions as they get further away or closer to that equilibrium area, and kind of more manage these positions in and out of them, as opposed to, what we used to do 10 years ago, which was just like, hey, I'm buying at $80.10 with a stop loss at $80, and I've got 10 cents worth of risk. And we do still do that sometimes, for sure, but it's a little bit different of a way to trade it. But it's really difficult for anybody who is entry level or who is a smaller account, because, again, you can't actually define the risk in the same way, and that inherently makes it significantly more dangerous. And if you start too big too early, it can lead to a lot of punishment. So that answers the person in the YouTube's question who is no longer able to hear it. Another person on YouTube asked me my opinion on silver, but you can't hear me now anyway. So, I would just say silver is in a much more difficult area, and back here at 75. I think structurally, I'm more bullish than bearish on this. Tactically, there's nothing to do here at $75 in silver. From Kevin, what is your process for dealing with a large loss, particularly taking a ton of stops in rapid succession? I do get mad when I have to take a stop quickly on a big picture swing idea that I'm prepared to be very patient with. You're losing fast while it takes time for your winning positions to fully develop, making me feel like I'm always behind and chasing my own P&L. How would you deal with this issue as a momentum trader? I've been trying to smooth out my P&L by day trading, but that's been very unsuccessful so far. Sure, so there's a whole ton to unpack in these questions and comments. So now that I read the whole thing, let's try to do it piecemeal here and see what we can derive from it. What is your process for dealing with a large loss? I probably have too many drinks, particularly taking a ton of stops in rapid succession. Sure. So when thinking about what my process is for dealing with a large loss, it matters. Like, context really matters. Is this a large loss that happened on just one individual day, or has this been more of like a series of large losses? Is this something that's bigger picture or smaller picture? Like, what does it look like? If it's a one-off day, I don't change. I don't do anything different. I don't change anything. I make note of it. I make note that I'll ask myself if I made a risk management mistake on the day, and if the answer is yes, then I need to make sure I don't do it again. But otherwise, if it's just a one-off day and it's a big loss, it just sucks. But it's almost kind of part of the business, as long as it's within the realm of your maximum loss. So, what you're telling me is that a large loss should be that I achieved my maximum loss that day. It should never be that I exceeded my maximum loss. If I exceeded my maximum loss, that means that I had a risk management mistake, and then I need to go in and dissect what the risk management mistake was to make sure that I don't repeat it. You hear me say this all the time, and I'm not like being patronizing. The key to success in trading is as simple as making more money than you lose. That's all you got to be able to do, is make more money than you lose. The key to success in trading is making sure that you never have losing days that exceed what your maximum loss should be. It's more important than anything else. And then you just need to have occasional outliers in your favor. So really sticking with the discipline on the risk management side is the most important part, I think, of basically all of this. Now, if it's a little bit bigger picture, like a bigger picture percentage account hit, or consistent really bad days where things aren't coming together, then I need to reassess process. Reassessing process starts with sizing down. The worst thing you can do, use the term chasing my own P&L at some point here in your commentary. It's the worst thing you can ever do is have this idea of making it back. If your idea is to make it back, all that's going to happen almost always is that you're just going to dig yourself into a deeper hole. We want to remove ourselves from P&L and focus on process. P&L is the result of process. So you can't focus on a result. You have to focus on, you can't just say, I'm trying to come up with an analogy. You can't just say hey, so, I ran a mile yesterday and I ran it in 9.5 minutes. So I want to be able to run a 7-minute mile. So tomorrow I'm going to run a 7-minute mile. You're just making the goal the process, and that isn't possible. So especially when it comes to trading, the worst thing you can do is think about making P&L back, things like that. You need to just focus on all right, what is my process? Is my process sound? Is the risk within my process appropriate after the losses that I just took? And then if the answer is yes, just do the right things over and over and over again, and then P&L comes naturally. That's what you need to do in order to get back. So if you took the bigger picture loss, the bigger picture drawdown, which definitely happened to me at a certain point last year with those 3 names that I mentioned, you just got to make sure that you're trading at an amount that's appropriate for where you are right now. Not where you are a month ago, not where you were 6 months ago, where you are right now. And it's very difficult. I know this personally. It's very difficult to reduce your swings because you just get so used to a certain amount of P&L moving back and forth. It feels so normal to you to see certain amounts that when you then are reducing those P&L swings by a factor of X, the numbers sometimes almost don't mean anything to you because I was used to swinging back and forth this amount, and I just took this gigantic loss, and now I'm just trying to swing back and forth a percentage of that. But that's just completely the wrong way to think. You have to think about process. Our human brains are so bad at understanding compounding math, where maybe that loss took you a month to happen or whatever, and it's a really big loss, and the math behind things after you size down means it's going to take 6 months just to get back to where you were. But within the confines of that 6 months, if you really have it done properly, it's going to get bigger and bigger and bigger and bigger over the course of that 6 months, where then very quickly you're just kind of back to where you were. And you're better off doing that process, from my experience, than you are just sticking with the big size and trying to make it back, because you can so easily put yourself into a hole that you'll never be able to get out of if that's what you end up doing. You're better off taking 6 months to slowly build your way out of the hole than try to make it back in 2 weeks and not have a career anymore. So that's the biggest part of it. When you say having stop losses hit in rapid succession, I would just circle back to making sure that you actually have the appropriate amount of risk on for any given point in time. You need to know how many open trades you have and what. Look, I'll tell you, I've been training long enough. I feel like I've made every mistake, and I've had every piece of bad luck and every piece of good luck and everything in between kind of happen to me over time. I've been in situations where I've got like 7 longs and 5 shorts, and all my longs go down and all my shorts go up at the same time. And you might think to yourself, like, if all 12 of my trades were to go bad at the same time, I'm going to lose X amount of dollars, but it'll never happen because 7 of them are long and 5 of them are short. I promise, you trade long enough, it's going to happen. So you need to always know the worst case scenario of every possible thing. You never know when news is going to come out that moves things in different directions too. Um, so you just need to be prepared for that. So to me, this sounds like what you're describing is that you have just too much overall risk on at one time. You have too many trades on overall at one time, and therefore when they're all failing at once, the loss is exceeding what your maximum loss should be. So this circles back to me, based on what I'm reading here, as you having a risk problem. Not just like a one-off day where you shouldn't change any process. You have a process problem that needs to be adjusted, and then you can focus on figuring out what the right things are to do and kind of building it back up. As far as how do you deal with this issue as a momentum trader, I don't think you deal with it any differently than you deal with any other approach. I would just say that you should also try to expand a little bit beyond just being like kind of a, for lack of a better term, one-trick pony, because you're not always in a momentum environment. or at a minimum, know when you're not in a momentum environment so you're trading significantly smaller than otherwise. It circles back to this morning's morning meeting and afternoon meeting where we talked about like, hey, this market's giving me a mixed message right now. I don't have a lot of conviction, so I'm trading smaller. If the market is not set up in a way towards your momentum edge, then you should be trading significantly smaller. But I would also say that you should try to have a big enough of a tool belt that you can trade multiple environments. So work on that, which it sounds like you're trying to do that with some day trading, and that's fine and good. But when you're trying to learn a new approach or a new strategy, you're probably going to lose money at it. So you as you're expanding your skill set, when you first try a new skill, imagine shooting a bow and arrow for the first time. If you've never shot a bow and arrow before, it doesn't mean that you can't be a super successful bow and arrow shooter. It just probably means that the first time that you ever do it, you're going to be pretty trash at it. So start small. Start small while you're trying to learn and figure new things. Do it with inconsequential P&L so you can build that skill set for yourself in a way where you don't hurt yourself, because when you're trying stuff that's new, you're gonna lose money in it almost inevitably. Hope that helps. From Greg on catching falling knives, you can also use weekly or monthly options to define risk. Yeah, you could do that as well. Even for a smaller account, I bought Hood and IGV calls Thursday. Not enough. It was like a 2-layer cake. Also, given after hours, the real puke I couldn't add, worst case scenario. But generally, options is a good way to layer into some medium-term trades for like a bounce to ADMA or equilibrium with defined risk. Cool. Thanks for that, Greg. All right. Well, I lost the YouTube, so I got no questions in there. This internet problem is a problem. I'm good all day. I just feel bad. It's the only thing now that's not working. Is trying to do the live streams, but maybe it's also a coincidence that it dropped twice in this little hour that we had here. I'm gonna end it then. All three of me, we're gonna end it then. Have a great night, everybody. I'll see you all tomorrow.